Hello, everybody, and welcome to East Daily's second webinar on the FERC rule tax changes. My name is Justin Carlson. I'm Managing Director of Research here. With me, I've got Matt Lewis, who's a Director of Research. What we wanted to cover today is yesterday we spent some time talking through some of the more macro-level changes, or at least a macro look, a real quick look at what that FERC ruling meant. We're going to review that again today. But we're going to go a little more detail into the assets and the individual pipelines and some of the implications. We also, this is a little bit of a follow-on from our Dirty Little Secrets report that we put out earlier this year, where we put out a table regarding what is the rate of the return on equity for the natural gas pipelines. And we did that using just looking at the tax changes. But what we've done is adjusted that with regard to some of the latest FERC ruling to see the further implications. So we'll show some of those tables here and highlight some examples. There are absolutely more details available. We sent a snapshot and even Excel file out to our clients this morning. So there's a lot more detail in that and pipeline specifics for various various assets across the country. So feel free to refer to that and talk to us or give us a call if you have more detailed questions. But again, today we wanted to go through as some examples so we can look at how to read those tables, what it looks like, and what the implications are. So with that, I will pass the mic forward to Matt and let him talk through some of the very macro level implications. And we'll go through this first at natural gas, and then we'll talk about liquids pipelines. So with that, Matt, go ahead.
Thanks, Justin. So thanks for joining us, everyone. And yesterday, as you know, was a whirlwind. So we wanted to get something in front of you guys. So the snapshot yesterday was really our first reaction to what was happening, and then the quick call that we did. And this will be a quick call as well. But we've had a little bit more time to digest what the FERC has said and put some examples here for you and pull some more data from our database that may be helpful for you. Things like percentage of negotiated revenue that's on really all the natural gas pipelines. We pull that from our database, which comes from the FERC forms. So those are public and those are available, and we have those. So just a recap of what happened yesterday and the impact of these new tax change rules. I'm sure most of you are familiar with the changes by now, or the proposed changes by now. On the natural gas side, the FERC has decided to reverse course on a long-held stance that they weren't double counting interstate tax allowance on interstate pipelines for MLPs, both liquids and natural gas. So that was a case with United Airlines that the Federal Appeals Court had reverted back to FERC to look at and really justify how they were measuring ROE and give them the option to change ROE measurement if they wanted to do that. But the FERC has reversed course and said, we agree it is double counting and we are removing that. So you have some large implications from that piece for natural gas pipelines, certainly lesser of an extent for oil pipelines, but the MLPs, it's a big change for them. And we'll get into some of those effects. The notice requires all natural gas pipelines to file a one-time report and on the rate effect and the new tax change laws to the Commission's income tax policies. So the Commission wants to capture, number one, from C Corps, what type of benefit they are getting from a reduced tax allowance or reduced taxes, what type of benefit that gives the pipeline, and how to measure that in rates for the large tax cuts that we saw at the end of 2017. So the Jobs Act tax cuts, those are affected by for C Corps as well as MLPs, less so for MLPs now since their tax shield is being taken away completely. And then the other piece is the tax shield that's being taken away from MLPs. So in our opinion, if you listen to the presentation, I would recommend everyone listen to the FERC presentation on it. It's in our opinion, it's quite hawkish to these pipelines, and it's our opinion that FERC wants to see these tax changes flow down to the shippers or the customers as part of these lower tax rates and changes in tax policy. So I would keep that in mind. You hear some of the companies coming out and say de minimis effects, and that's certainly true for some of them. There's others where we think that maybe they're downplaying it a little bit because they do have a significant amount of their revenue exposed to max tariff rates that can easily be taken down by the FERC. And in our opinion, the FERC is being quite hawkish here and does want to see lower rates on a lot of these pipelines. On the liquid side, we touched on this yesterday, but you always have that piece hanging out there. They've kind of delayed any type of activity until 2020 on this piece, but you still have the proposed rulemaking where it's been out there for a year or so, a year and a half, where they propose if your liquids pipeline is showing a revenue of 15% over the cost of service in the year-end annual FERC form, you may not be allowed index rate increases on the liquids pipeline. So that is still out there. That was not ruled on. That's still a proposed change. We may see that come out soon. We probably won't see that until closer to 2020 would be our guess, as they do the index methodology true up in 2020 over again. And one piece that we didn't touch on yesterday and we hashed out during the day, there is another effect to these lower tax rates on these liquids pipelines, and that has to do with the true-up they do every 5 years for the inflationary factors that these guys get to add in based on PPI plus a margin. So the way FERC does this is every 5 years, they go back to the previous 5 years and look at the liquids pipelines they regulate and look at the annual financial forms for the liquids pipelines they regulate, and they look at how costs have trended. So they look at things like operating costs, maintenance costs. Also included is income taxes as well, though, which is kind of where this comes into play, is they look at those costs and say, okay, costs in 2015, they looked and costs had increased about 4.2%, I think was the number, was what FERC calculated. They looked at the PPI and said, oh, it was about 3%. So let's tie for the next 5 years, let's tie the increase to PPI, which was around 3% for those past 5 years, plus 1.2% to get us up to that 4.2% that we had seen over the past 5 years from our liquids pipelines. So that's how that methodology is taken care of. Now, where this becomes a little bit interesting, and to be honest, it muddies the waters a bit, is when they do the true-up again in 2020, you will have the effect of those lower tax rates in those costs of service. So liquids pipelines in 2019 is the year FERC's going to use to look at the costs, at least on the income tax allowance piece. Those costs will be significantly lower. That will add deflationary pressure to the methodology true up in 2020. So we'll talk about that a little bit more in depth in a later slide here.
Thanks, Ben. Before you get into some of the numbers, I want to remind the audience to feel free to use the chat function at the bottom to ask questions, and we'll address those questions at the end of the call.
So going to the next slide, and we had this table in yesterday's WebEx, but we've made it a little bit easier to see, and we've pulled some more information that I'd like to hit on as well for our clients that I think will be useful. So this is how we look at Transco under what we consider like a worst case scenario, to where you can see on the left hand side of the table there, it's our calculation based on 2016 financials of their calculated return on equity. 13.4%, it's a little bit at the top end of the range of where we consider the safety zone of a 10 to 14% ROE, but certainly nothing to get worried about. But with the tax changes that we've seen, their composite tax shield goes away. So that $225 million you see there essentially goes to zero, raises the net income by that same amount, and you can see the effect on ROE there, ramping ROE to 21.45%. So as we talked about yesterday, the 225 should really be seen as like a worst case scenario. There's mitigating factors here that you should always take into account. Mitigating factor one is they've clearly doing a lot of integrity work on that pipeline over the past 2 quarters, which is going to be included in the rate base or the rate case that they're filing in 2018. So our estimates show they've added about $60 million in costs that they typically don't have for the first 2 quarters of that base period. So extrapolating that forward, about $120 million, if we assume that continues, that will be added to, it's a straight decline or a reduction on net income, which will lower the ROE for Transco. I touched on it a little bit yesterday. The negotiated rates thing, absolutely it's very unlikely that FERC will adjust down negotiated rates. I always caution people to make sure that the negotiated rates are actually the piece that's over-earning. That's an important distinction to make. In a lot of these pipelines, that's definitely the case. So they are significantly over-earning from those negotiated rate agreements, and those agreements are unlikely to be adjusted until the term runs out. So there is some protection from there, and Transco does have protection from there. So what we did was we went ahead and pulled the FERC financials, and they actually have this in the FERC financials so that we scrape all this data from the FERC. But they actually break out for every pipeline that they regulate is the percentage of revenue discounted revenue the pipeline receives, the percentage of negotiated revenue that the pipeline receives over the course of a year, and then really the difference is what's at max tariff. So you can see here, based on 2016 filings, the max tariff revenue is about 62% of Transco, and then about 38% is on discounted or negotiated rates. So I believe Williams has released a number that says about 50% of our revenue will be at max tariff, or will be at negotiated rates by the end of the year. That's because Atlantic Sunrise is coming online. It's a large project. There's a lot of negotiated agreements. I believe they're all negotiated agreements on that expansion. So that will bump up their revenue from negotiated contracts by the end of the year, certainly. But the revenue that is at the max tariff rate is very much exposed to lower rates here. So taking into account the mitigating factors, I know Transco Williams has guided to potentially being able to raise rates, but that was before this tax shield was taken away from them via the composite tax rate going to zero. I think it's a tough sell for them to be able to raise rates, so that we do see some downside there. Certainly not the $225 million you see there, but there is some downside, in our opinion, to Transco in this upcoming rate case in 2018. So the other thing that we did yesterday and last night was we reran our numbers to take away the tax shield on some of these MLPs. So in our Dirty Little Secrets report that Justin mentioned earlier, we had previously ran these numbers based on the decrease in corporate tax rates. So you saw a decrease in the tax shield, but not a complete elimination of the tax shield. So we've eliminated the tax shield in this case and shown really where ROE goes under those circumstances. In using 2015 and 2016 as proxy years to just show, hey, under the old tax shield and old tax rates, you had ROE of X amount. If I take that away, this is what the effect on ROE is. And as you can see, we put those here. And all the pipelines we cover, we harp on it, but you really need to look at this at an asset level. There's mitigating factors for every one of these pipelines, some good, some bad. But it's important to note those mitigating factors and how that's going to affect what they decide to do for rate cases going forward, or how they're going to deal with these changes. So we've gone over the Transco one. We see it as medium risk. We would agree with them as we would think that they, under the old tax scenario, even under the tax cut to 21% corporate tax rates, they were in a pretty solid position to be able to keep rates probably flat would be our base case. Now with the tax shield eliminated, it's a tough sell, in our opinion, to be able to keep those where they're at, and we do see some downside there. Certainly nothing disastrous, but there's probably some downside there. Hit on a few others. As you guys can see, Boardwalk was down yesterday, probably down less than some others, which makes sense. But if you look at their pipelines, certainly at the bottom there, Gulf South is one where it's significant. It doesn't make a significant amount of ROE. They're significantly under-earning already. Elimination of that tax shield does not raise them anywhere close to being in the danger zone of above 14% on an ROE basis. So we can also look at Texas Gas. That's another one of their main pipelines. That's row 2 up there. They do bump up near the danger zone, but you do need to take into account that they've done those renegotiations on their Fayetteville contracts, which will significantly reduce 2017 and 2018 ROE. And they have quite a bit of contract attrition coming up here for those other Fayetteville contracts that weren't renegotiated with shippers like BHP and XTO. Those are likely to fall off completely. They have some south and north contracts that are likely to fall off. So taking all of that into account, it's pretty unlikely that they'll be above. They're probably in the safety zone once we take that into account and adjust for 2018 changes. So really, you can look at Gulf Crossing certainly, but most of those rates are negotiated, and we would expect rates to come down on Gulf Crossing as well into the future. So really, no large effect here for Boardwalk, and you still saw the stock sell off. Maybe a little bit more risk on Texas Gas, but certainly not a huge amount of a change for a company like that. Some other ones that I think are interesting. Algonquin's a Spectra pipe. I know Spectra was out saying today that minimal impact from the changes. If you look at their Texas Eastern asset, which is the second to last one there, certainly they're in a position where they're not in a horrible position based on 2016 financials and 2017 financials. We would throw them in the medium risk category. I would caution that their operating expenses and probably added some significant amount of dollars to the rate base in 16 and 17 due to the pipeline explosion that happened a year and a half ago. The OPEX really went up for 16 and 17, which has lowered Texas Eastern's ROE compared to what it would have been prior years. And you can see that the 2015 numbers are significantly higher on an ROE basis than 2016. So that would be one we would put in the medium risk zone. Algonquin's one we would put in the high risk zone. Now, you don't see that by looking at the 2016 numbers because the AIM expansion was added to the rate base completely, and they only received about 2 months of benefit from that expansion on the revenue and net income side. So that's misleadingly low on the Algonquin piece, that 11.52%. The pro forma that I've run puts their ROE under the new tax shelter at around 20%, which we would put at high risk in the danger zone. And I know they've come out and said not significant impacts. I don't see how they get away from lower rates on Algonquin. We can argue about how low they would be. I think about half of their revenue is under negotiated contracts, so they would have some protection there certainly. But there's probably There's probably some downside to Algonquin via some lower rates there. And then we can get in the argument about what's material or not. Is $50 million a year? I'm just throwing a number out there, but that's approximately probably where we would bucket Algonquin's risk. Is that material to a company like Spectra? Maybe, maybe not. So you can argue about that stuff. Great Lakes is the last one. They're an interesting one because, I mean, as you can see, their ROE score is pretty high. Based on the financials that we pulled. They have done a rate case. They did a rate case in 2017. What's interesting about their rate case is the stipulation in it is that if FERC shows that tax rates should go lower, you have to comply with that lower tax rate. So we see the risk is very high that they will actually have to reduce rates because of the decision FERC's made on the piece of MLPs. Question there is if they can argue that TransCanada owns enough of Great Lakes to make a difference. I'm not sure if that's true. Justin, do you know TCP owns a piece of Great Lakes, but TransCanada still owns a piece? Okay. So not really sure how that would play out, but it sounds like there might be some risk of lower rates there. Going to liquids pipelines, we hit on this pretty good yesterday. As the effects are likely not to be seen until 2020, and then you have the proposed ruling on the cost of service being above 15% and freezing those rates. As a reminder, that's just a proposed rule. We'll see how that comes out. But the other piece is really lower tax rates put deflationary pressure on the FERC calculated adjustments that they true up every 5 years. And we'll hit on this more in just the next slide, but just going over a couple of the companies on point one on the liquids pipelines is we've rerun those numbers as well and eliminated the tax shield from some of those MLPs, and you can see the effects on the new ratio. If the new ratio is above 115%, they would run the risk of, under that FERC proposed ruling, of seeing their rates frozen if FERC was to enact that as a rule. So you can see Buckeye Partners is one where under even the old ratio, 110%, If we ran it with lower tax rates, it actually scored about 114%. But if we eliminate the shield altogether, you do get above that 115% point. What's important to note on Buckeye, they do have mitigating factors here as well. So they do have market-based rates on a significant portion of that pipeline that they could argue are the pieces that are over-earning. We would need more disclosure from Buckeye to be able to say that, but I'm sure that's what the line that they'll take is the market-based rates are the piece that are over-earning and our cost of service are not. So there is a mitigating factor there where Buckeye might be okay and not be susceptible to that freeze in rates. Certainly not on their market-based piece would they be frozen there. Enbridge Energy Partners is an interesting one. I'm sure you guys have seen the announcement. It's set in their contracts that they've signed up with, either with shippers or with ENB, that if the FERC lowers the income tax allowance, their rates come down. So that is set in their cost of service agreements on their facility surcharge mechanism on the Lakehead system. So that's why you see anytime there was a corporate tax cut in Q4, you saw them drop their DCF, their guidance, and you've seen them come out today with a similar announcement. It's because it's a straight cost of service agreement that's written into the contract that they have to do that. They have to lower the rates in that situation. Magellan, gotten a few questions on Magellan. I know they came out with something that said they're still below their cost of service, and we agree based on 2016 numbers. We rerun those, and you can see their revenue at $501 million is still below their cost of service, even when we remove that tax shield at $523 million. So you have these names. It's something to think about. Enbridge Energy Partners. I'm sorry. I hit on their Bakken I hit on their Lakehead system. If you look at their Bakken pipeline, that is one that is also over-earning, but it's likely they'll have some MVCs come off, a small amount of MVCs come off here in the next quarter or two. It's unclear when those fall off. They do have extended MVCs. Some were, I believe, 7 years and some were 10 years on that system. But that would be one that would also be susceptible to having rates frozen if their ROE weren't to come down. But their ROE will come down as they have seen some volume loss due to DAPL coming online. Deflationary pressure, I want to hit on this one again really quick. We hit on it at the beginning. We didn't hit on it yesterday. But what we did is we have all the FERC financials database, so it's really easy for us to pull this information. So we pull the total cost. What we did was we took all the liquids Form 6 filings, everything that's regulated by FERC, and this is similar to the analysis, obviously more rudimentary is what we did yesterday, but similar to the analysis that FERC does when they decide what index methodology, what rate increases they should get on that 5-year true-up. So we pulled all the liquids pipelines. We pulled the field where they show what their total cost of service is. We pulled the field where they show what their income tax cost is, and then we made an adjustment to that income tax cost for each of the pipelines. So corporate pipelines were adjusted down 40% due to the lower corporate tax rates, and then we eliminated the tax allowance or the tax cost altogether on MLP pipelines per FERC's order yesterday. So what you see is a reduction in costs. So this is really important to note is when they do that 5-year true-up, they look at not just operating costs, not just maintenance costs, they look at all costs of the pipeline. So all else equal, you're going to see a 9% decrease because of these lower tax rates to the cost of service on liquids pipelines based on 2016 financials and our estimates on that. It should be pretty close to 9%. Now, this is a proposed ruling, the ruling that they put out that oil pipelines don't have to do anything until 2020. I'm sure you'll get comments on how they're going to deal with this deflationary piece. I do know, and again, if you watched the FERC meeting yesterday, it's very apparent via the back and forth from the staff and the commissioners that they want to capture that lower tax rate into this 5-year true-up in 2020. The 9% rate should be looked at. It's unclear how they're going to deal with that, if they're going to amortize that over 5 years. So you see maybe a 1.8% cut over the course of 2020 to 2024. It's not clear how they're going to deal with that. I don't think they do just a straight step down of 9% in 2020, but certainly that's something that could be an option. But just keep in mind that there is pressure on that, on your ability to increase rates on those oil pipelines. So instead of this year, or in 2015, they redid the methodology, and it's PPI of finished goods, inflation factor plus 1.2%. You'll probably see a lower amount than that. You may see PPI finished goods minus 2% or something along those lines because of the lower costs that you have bleeding out because of the lower tax rates. That does get factored in there. So that's something to keep in mind. Again, just to recap, we still see more risk to the gas pipelines. It just seems like, based on the ability of FERC to regulate those, more significant regulation on those, they're less hands-on with the oil pipelines. It's clear to us, it seems to us that they're very hawkish on this, and they want this to feed through to lower rates on some of these pipelines on the natural gas side, and certainly on the oil side as well. Maybe not lower rates, but really maybe mitigating or limiting the inflationary factors or cost increases or the rate increases that you're allowed to do from 2020 onward.
Thanks, Matt. Well, there's a lot of questions coming through, so let me try to get through a couple of them, and I'll see if you can answer them. On the PPI, since we've just left that discussion, let's go back to that and answer just a couple of questions I saw come up on that. I know you mentioned roughly 4.2% was the last calculation as the index, as the indexing for the liquids pipelines. Do you recall? I believe before that we may have even had some negative stuff. But if you can go back in time, just as far as you can remember, what those the last couple of years that we've been watching, what that looked like.
Yeah. So I think it's always been positive. So in 2015, the FERC looked and said, hey, it's about 4.2%. Where you saw some negatives come in was where you had PPI that was negative in some years. So if you have PPI plus a margin of 1.2%, which is what they've set up, is if you have a negative PPI, then you could potentially get a negative amount there. So that would lead through to a situation where, let's just be hypothetical and say in 2020 it ends up looking like PPI minus 2. You would need a PPI to come in at plus 2 to just keep things even in that situation. So you could see lower rates. The max tariff rates on some of these liquid pipelines come down each year depending on what PPI does.
So is it fair to say, as we look at the go forward and we think about, we add that indexing into all of our models, into our detailed asset models at an asset level, and we standardize that across most of them, and historically we've used roughly 3% as an average going forward. Past 2020, it is all likelihood that we would keep that flat to maybe slightly positive, just based on what we know today.
Yeah, based on what we know today, I think that's what we would change our base case to. So for the years 2020 to 2024, I would advocate, and we can talk about this internally, and we'll talk about this internally, but I would advocate lowering that 3% rate to maybe 0.5% or 1%, or maybe just flat altogether to take that into account.
You addressed this, I think, in the beginning when you talked about the difference between liquids and gas pipelines, and maybe you can just rehash on that and why there's a focus on from the FERC on gas pipelines, given the regulatory environment and how they're regulated based on different regulatory stipulations.
So it's important to note that FERC is definitely more hands-off when it comes to liquids pipelines, and that stems from legislative action that happened in 1992. Congress passed some sort of a bill that directed the FERC to have a simplified way of regulating rates and tolls on liquids pipelines. It's very different from natural gas pipelines where it's anything but simple. So on the liquid side, and that's where they developed the indexing methodology, where it makes sense at a simplistic point of view to, hey, let's look at the liquid pipes over the last 5 years and see what their inflation was on costs, and we'll give them that increase over the next 5 years, and then we'll true it up again in 5 years. I mean, that makes some sense. Where some people have complained is you have some pipes that are new and don't see a lot of inflation, and they're getting those increases even though they're significantly over-earning their cost of service. So on the gas side, FERC does have their hands in that quite a bit more, and does wield quite a bit more power on the gas side. And from our point of view, they are being hawkish here, and they do want to see lower rates because of the tax cuts and the changes in policy on the MLP side.
With respect to C Corps versus MLPs, and maybe specifically, since we have this example in here, you can comment on WPZ versus WMB with respect to, does it make sense to try to roll Transco up into the C Corp, or various scenarios regarding C Corps and MLPs, and what our thoughts are there.
Yeah, listen, it's one variable that needs to be taken into account, and it's definitely having this come down from the FERC is some incentive to do that. Transco would definitely get away from that elimination of the tax shield if they were, in our view, if they were to transfer over to the C Corp. That's beneficial for them. Whether that offsets the downside, the cost of changing over to a C Corp, the fact that you would be a corporate tax entity at that point, I can't say, but that's certainly something I'm sure the Williams people are considering. The other piece is, I think you've seen three kind of incentives come about that may, especially on the gas side, that may incentivize these guys to really think about if they want to become C Corps. The first was just the lower tax rates for corporations, going from 35 to 21% changes the bar of what you're taxed at a corporation. So all else equal, there should be some incentives to move over from an MLP structure to a corporate structure. Second was the one we just talked about, the elimination of the income tax allowance for MLPs. That takes away an incentive to be an MLP. It just does, whether right, wrong, or indifferent. It just does. The other piece, and I didn't hit on this, but I think it is actually important to talk about, is the ADIT, the accumulated deferred income taxes. There is talk about potentially, and FERC has put this out for comment. This is the other thing that they did yesterday, is they put this out for comment. They're seeking comments on how to deal with accumulated deferred income taxes. So these pipelines may have to refund some of those accumulated deferred income taxes over the course of time. I'm sure this is how it'll play out. It'll be paid out over the course of many years, possibly up to as many as 20 years is what I've heard. But that's further downside to potentially being an MLP and having this stuck on you. So certainly, I think on the gas side, certainly there will be a lot of corporate teams thinking about the pros and cons of becoming a C Corp after a ruling like this.
Okay. Couple of other questions, and you addressed this a little bit with Great Lakes, and I don't know that we have a great answer, but maybe I'll just follow it up.
Sure.
Again, with pipelines that are owned by both a GP or C Corp, as well as an MLP. A couple that come to mind, obviously Great Lakes, which we talked about, which is 46% owned by the MLP, and the remainder owned by TransCanada, and then you've got one that's maybe has a lot more hair on it, which is like Northern Border, that's a complete 50-50 split.
Yeah, I don't think it's clear what's happening there. I mean, that'll need to be something that FERC will need to decide, and we'll see what they say on that. But it's clearly something, one of the unique features that needs to be clarified by the FERC as part of this process.
Okay. Could you maybe comment just, I see another question coming through just on the rate pressure on the index, and doesn't it just allow for increases, or are there, in other words, won't the disallowance of taxes not drive tariff cuts in all liquids pipelines?
Well, so I guess it depends on how they decide to take into account this cost of service reduction. So I would not think, I do not believe it's right to think about the index adjustment on liquids pipelines to just be positive. I don't think you should think about that. I do think it's a real possibility that you could see the oil pipelines in 2020 have their PPA, that have the methodology changed for the next 5 years from 2020 to 2024 to PPI minus a margin potentially because of those decreased costs that we've seen. And typically you don't see that because you don't have large swings of costs cut. There's inflation that's brought into account. So I don't think you've ever seen an actual negative margin on the index. I would have to go back and check on that. Certainly when PPI becomes negative, sometimes you get a negative year, but the margin, I'd have to go back and look, and maybe one time it was negative, but that certainly is a possibility. I would note that there are mitigating factors here too. The 9% number, it's not going to be every year. It's not going to be 9%. That'll be somehow amortized or shifted down in 1 year, and then everything goes back to a normal PPI plus an inflator factor. But it's clear FERC wants to take that into account and capture that, the reduced tax rates. And again, if you haven't watched the open meeting, it's an hour long. There's super boring parts, but there's interesting parts too. And I think it's good to watch. It's good to get a feel for how the commissioners are looking at this. So yes, it is possible that you see decreases. You see PPI minus a 2% margin or something like that over that 5-year period. I think that could happen.
Maybe, and these are a couple of these are just on some information or data specific pieces. I know we've put quite a bit in the snapshots that we've released to our clients, including tables that have the difference between how much is negotiated versus non-negotiated rates. But maybe comment just a little bit on the difference between PP&E, property, plant, and equipment for a major pipeline and actually what their rate base is calculated at.
Yeah, so there's some adjustments that need to be done, and if any clients are out there and want the specific equation, we pull all the fields that FERC uses for that ROE equation and can lay those out for you. But it is PP&E, essentially minus depreciation. There are some other adjustments that are made in there, adjustments made for if they own storage or if they have base gas in the pipeline, there'll be adjustments for that as well. And if you want to do this on your own, feel free. Before we had it all databased, I used to take it in by hand. It's a good way to learn exactly what's going on. But you can pull the recent Section 5 filings and look at the end of those, and FERC gives you the fields to pull and the equations to use to calculate that ROE.
Okay. I'm just scanning through here and seeing if we've got a couple more questions that I could have missed. Certainly on the negotiated rates versus discounted rates versus total. I mean, for us and looking at those numbers, the negotiated rates, discounted rates are something that FERC lists relative to the total revenue that the pipeline makes, or at least on the transportation side.
Yeah, we pulled the actual transport revenue, so you should be seeing good numbers in the snapshot that we sent out. Those should be all correct. So they list the revenues for the year that come from discounted contracts, really all the discounted revenues they make from discounted transport contracts, all the revenues they make from negotiated contracts on transport, and then a total transport number. So to get our max tariff number, we're just doing the algebra there. Total minus negotiated minus discounted equals your max tariff.
We talked about this quite a bit in the office yesterday as an example of trying to look at negotiated rates versus max tariff rates versus cost of service, and how for every pipeline you have to break it apart as much as possible, knowing that some of the, let's say, negotiated rates may be on a cost of service for an expansion that would be an isolated piece that should be separated out from, say, legacy contracts, which could be on a max tariff rate, which absolutely be subject to a potential downside risk. So maybe if you can help just elaborate on that piece of the equation where you are trying to compare negotiated rates, or at least talk through. I know it's one of those things that's easier on paper than it is verbally, but maybe if you can't elaborate on that a little bit.
So I just think the warning I would give is I think that the company line from all the MLPs is we have X amount of negotiated rates. The impact isn't there. There's not a lot of impact there because of this. And I just think it's misleading. Certainly, the negotiated rates help you and can protect you in a lot of circumstances. So in a situation where you have negotiated agreements that are well above the cost of service of that piece of the negotiated. So the way I like to look at it is with expansions. Expansions always have to file, typically if it's not under the blanket certificate, they have to file with FERC an expansion. And they have to lay out, here's the cost of the expansion, here's the cost of service of the expansion, and here's what our revenues are going to be. So in the case where you're significantly over-earning that expansion's cost of service, you're absolutely protected, and there's a lot of pipes like that, and there's a lot of contracts like that. So looking at the percent of negotiated contracts, of revenue from negotiated contracts, is helpful. A pipe that has above 80% negotiated contracts is very unlikely to see significant pressure because of a rate case. There's just too much that can't be changed. But a pipe that has 40 to 50%, even up to 60%, there's a lot left that can be changed. And it's not apparent just by looking at a percentage of negotiated contracts where the over-earning is occurring from. So the example I always like to use is Tennessee Gas. Tennessee Gas is certainly somewhat protected from a negotiated contract standpoint. They have a significant amount. I believe it's about 60% of their revenues are under negotiated contracts on Tennessee Gas. So a good amount of protection there. But if you look and see why their ROE was as high as it was the past few years, it's because they signed up a lot of winter short-term marketing contracts. And they absolutely are over-earning because they have good negotiated contracts that are above the cost of service. That's definitely part of the equation. But let's not ignore the other part of the equation where they had a bunch of short-term contracts. They've over-earned because of that. That should probably need to be taken into account in a situation where TGP has to go to FERC and justify rates at this point. So keep that in mind. It's just a warning I like to give that, like, even though you have a lot of negotiated rates, and FERC likely won't shift those negotiated rates, that is their longstanding policy not to change those and move those up or down. You do still have risk on other pieces of the pipe. Certainly not a pipe that has above 80 or above 90%. You are fairly safe there from a standpoint. There's just not a lot of room to move down those non-negotiated rates to make the needle move very much.
I think we saw yesterday that there were actual Section 5 rate cases initiated for, I believe, Dominion South and Dominion Overthrust, excuse me, and then one other one. Yeah. And maybe I don't know if you can speculate on this or not, but maybe on the timing, or was there any stipulation on timing for all the natural gas pipelines to submit that brief on what their on their rates, or how, I guess maybe more in a bigger sense, how is FERC going to deal with all this stuff coming through, and is that still a big unknown?
I mean, I think it's a priority for the FERC, so I mean, fair enough to say that this could cause a lot of delays if potential Section 4 is coming through, settlements with shippers on some of these pipes coming through, Section 5s potentially being filed by FERC. The Section 5s that I saw yesterday, my theory is those were already in the hopper probably late last year before even the initial tax cuts happened. So it's my theory that those were already in the hopper and they just pushed those through. It was a good time to do so. So I wouldn't connect that in any way to the changes we saw them announce yesterday.
Okay, and then maybe one final one, because I think we're running out of time here. But just on the index adjustments, that is on an industry-wide basis. That's not on a pipeline-by-pipeline basis. Yeah,
I think it's an important note, and I'm sure this will get commented on by a lot of people. They do look at the liquids pipelines and don't, at least previously, have not discriminated versus an MLP liquids pipeline versus a corporate pipeline. So the rate cuts, or the tax allowance cuts that you see from the MLPs, are going to tug down the costs of the liquids pipelines for all the pipelines. So the guys that are C Corps may see a little bit of it's kind of a bad situation for them that they're getting pulled down with the MLP guys, because historically the FERC has looked at that true up over 5 years holistically, and I'm sure there'll be comments on people that want them to change that, and maybe they will. We'll see how that shakes out.
Okay, I guess finally here, I just to validate on the natural gas pipeline ruling, we don't know the timing on when those have to come through. So, but it is a final stipulation. So likely the pipelines are quickly at work, or maybe not so quickly, but working on that now. Whereas on the liquid side, it absolutely is a proposal, and it's still out for comment.
Yeah, I think that's a fair overview of it. On the natural gas side, other than filing the one-time filing with the new filing that they've made that requires natural gas pipelines to make the filing to show what the decrease in taxes do to your pipeline and the savings that's going to be there. Other than that, they don't have to do anything. So that's important to note. There's no real deadline in place for anything, the Section 4s or anything. The pipes aren't required to do anything, although the FERC has said you are subject to a Section 5 rate case if you don't make a filing, and we think you're potentially over-earning. The FERC did say that. Now, the FERC's always had that power, so I don't think that's a change of anything, but I do believe it's hawkish talk from the FERC, and I do think if there's pipes that are kind of in that danger zone of the ROE based on an adjusted ROE, taking into account the tax cuts and the elimination of the MLP allowance, I do think they'll be aggressive with Section 5s against some of those guys that are in the danger zone and don't make a filing.
Okay. I think that's all we have the time for today. As I mentioned at the head of the call, we have a lot of data in our database. We can crunch these numbers and pass through this. So for our clients, please give us a call. Let us know if you have any questions on this. We'd be happy to answer you and try to go through each of the potential scenarios that play out for each one of the companies that we cover, and as well as companies we do not cover in full, because we have the data for all of them. So again, thank you for joining the call, and we look forward to talking to you soon.